Elon Musk just called Donald Trump's biggest tax plan a disgusting abomination. And this from someone who's supposed to be on the same team. This $4 trillion bill could completely change how much you pay in taxes, but it's also sparking the biggest political fight we've seen in years. Here's what's really happening, and more importantly, what it means for your money. Welcome back to Finance Simplified. And today, we're breaking down the One Big Beautiful Bill, a massive tax plan that's got everyone from billionaires to your neighbors picking sides. This isn't just political theater. This bill could directly impact your paycheck, your retirement, and even your electricity bills. So let's cut through the noise and figure out what this really means for everyday Americans. First, let's understand what we're dealing with. The One Big Beautiful Bill, yes, that's the actual name, is Trump's massive tax and spending package that just squeaked through the House 215 to 214. Think of it as the biggest tax overhaul attempt since 2017. Here's what's in it that could affect you directly. For middle-class families, the bill extends those Trump tax cuts from 2017 that were about to expire. It also boosts the child tax credit from $2,000 to $2,500 per kid, plus creates something called Trump savings accounts that give families an extra $1,000 per person to encourage saving. For seniors, if you're 65 or older, you get an additional standard deduction of $4,000 to $6,000. For many seniors, this could eliminate taxes on Social Security benefits entirely. For high-tax state residents, remember that $10,000 limit on state and local tax deductions that hit places like California and New York hard? This bill raises that cap to $40,000, but only if you make under $500,000 a year. For workers, here's something interesting. Tips, overtime pay, and auto loan interest become completely tax-free. If you're a server, delivery driver, or anyone working overtime, this could put hundreds of dollars back in your pocket every month. But here's the catch, and it's a big one. All of this costs money. A lot of money. According to the Congressional Budget Office, this bill adds $2.8 trillion to the federal deficit over 10 years. When you include interest on that debt, we're looking at nearly $4 trillion in total costs. To put that in perspective, that's more than the entire GDP of Germany. It's like adding $12,000 of debt for every single American, including newborn babies. Now you might be thinking, okay, but if I'm getting tax cuts, isn't that worth it? Well, that depends on how you look at it. Here's the thing about deficit spending. It's like putting expenses on a credit card. Sure, you get the benefit now, but eventually someone has to pay the bill, and that someone is usually future taxpayers, which might be you, your kids, or your grandkids. The Congressional Budget Office warns that every 1% increase in interest rates costs an additional $30 billion annually in debt service. That's money that can't be spent on roads, schools, or anything else that actually benefits people. This brings us to the most fascinating part of this story. Why Elon Musk, who's supposed to be Trump's ally, is absolutely livid about this bill. Musk didn't just disagree politely, he called it, quote, a disgusting abomination, and said he was disappointed to see the massive spending bill which increases the budget deficit, not just decreases it. But here's what makes this really interesting. Musk was literally in charge of something called the Department of Government Efficiency, or DOGE. His entire job was to cut government spending and reduce the deficit. Then Trump proposes a bill that does the exact opposite. Imagine spending months trying to organize your household budget, cutting unnecessary expenses, and then your spouse goes out and puts $4 trillion on the credit card. That's essentially what happened here. Musk's criticism boils down to three main points. First, it's fiscally irresponsible. He argues you can't claim to support government efficiency while simultaneously adding trillions to the national debt. Second, it's philosophically inconsistent. His exact quote was, "I think a bill can be big or it can be beautiful, but I don't know if it can be both." He's basically saying Trump's branding doesn't match the bill's actual impact. Third, it undermines everything DOGE tried to accomplish. If you spend months trying to make government more efficient, and then your own team proposes massive deficit spending, what was the point? This has created a fascinating political dynamic where Musk is opposing a Republican tax-cutting bill from the right, arguing that tax cuts without spending cuts are fiscally irresponsible. Now let's talk about who actually wins and loses from this bill, because the answer might surprise you. The big winners, high-income families in expensive states. If you're making $200,000 in California, that SALT deduction increase could save you $3,000 to $5,000 per year. Wealthy families, the estate tax exemption jumps from $14 million to $15 million, saving the richest 1% of families an average of $1.2 million. Small business owners, the 20% deduction for pass-through entities continues, which mainly benefits profitable businesses. The modest winners, middle-class families. You get tax relief, but analysis shows the top 20% of households get 65% of the benefits. Seniors with modest incomes, the additional deduction helps, but it's temporary and phases out for higher earners. The losers, low-income Americans. The bill adds work requirements to Medicaid and SNAP, potentially causing 7.6 million people to lose health coverage. Students' Biden-era student loan forgiveness programs get canceled, affecting 43 million borrowers. Everyone's electricity bills, clean energy subsidies get cut, with states like Wyoming projected to see 29% increases in electricity costs. Here's the pattern. If you're already doing well financially, this bill probably helps you. If you're struggling, it might actually make things harder. But there are some less obvious consequences that could affect everyone. Stock market impact corporate tax rates drop from 21% to 20%, which could boost S&P 500 earnings by 3 to 5%. If you have a 401k or investment accounts, you might see short-term gains. Sector winners and losers. Defense and traditional energy stocks benefit from $350 billion in border security funding and fossil fuel subsidies. But clean energy companies face a 40 to 70% higher tax burden. Interest rate pressure. Here's where it gets complicated. All this deficit spending could push up Treasury yields, which affects everything from mortgage rates to credit card rates. Higher government borrowing competes with private borrowing, potentially making loans more expensive for everyone. The clean energy setback. This bill could reduce clean energy installations by 110 gigawatts by 2035. That's massive. This might seem abstract, but it affects everything from electricity costs to America's competitiveness in future tech industries. International competitiveness. Chinese companies like CATL and BYD face new restrictions on U.S. partnerships. This might protect American companies short-term, but it could slow innovation in batteries and electric vehicles, industries that are crucial for future economic growth. So what does all this mean for your actual money decisions? If you're a middle-class family, you'll probably see lower taxes in the short term, but honestly, it's a good idea to start planning for potential future tax increases. The math is simple. This debt has to be paid somehow someday. If you live in a high-tax state, the SALT deduction increase is a real benefit, but only if you make under $500,000 in itemized deductions. So, run the numbers to see if it actually helps you. If you're young, this is where it gets tough. You're getting some immediate tax relief. But you're also inheriting $2.4 trillion in additional debt that you'll eventually need to pay back through higher taxes or reduced services. If you're planning retirement, the deficit spending could put pressure on Social Security and Medicare funding down the road. Don't panic, but definitely factor this into your long-term planning. If you're investing, traditional energy and defense stocks might benefit short-term, but clean energy faces headwinds. Consider the long-term implications of reduced clean energy investment for tech and innovation sectors. And if you're a small business owner, the pass-through deduction continuation helps, but watch out for potential future tax increases and higher interest rates that could affect business loans. This bill represents a classic economic trade-off: short-term growth versus long-term fiscal health. The optimistic case: tax cuts stimulate economic activity, businesses invest more, people spend more, and the economy grows fast enough to handle the debt. The Congressional Budget Office estimates this could boost GDP by about 0.5% to 1% in the short term. The pessimistic case: we're borrowing from the future to pay for today's tax cuts. When the debt becomes unsustainable, we'll face either dramatic tax increases or cuts to essential services. Remember, credit rating agencies like Fitch already downgraded the U.S. in 2023 due to debt concerns. The historical context. We've seen this movie before. The 2017 tax cuts were supposed to pay for themselves through economic growth. They didn't. The deficit increased significantly even before the pandemic. The international perspective. Other countries are watching this closely. If the U.S. debt situation deteriorates, it could affect the dollar's status as the world's reserve currency, which would have massive implications for American economic power. The fundamental question is, are we investing in future growth, Or are we just delaying difficult decisions and making them more expensive? So, how do you make smart financial decisions in this environment? First, plan for multiple scenarios. Tax cuts might continue or they might be reversed. Build flexibility into your financial planning. Second, don't make major decisions based on temporary tax benefits. Most of these provisions are temporary, expiring between 2025 and 2028, so don't take on debt or make big purchases just because of short-term tax savings. Third, consider the interest rate environment. Higher deficits could mean higher interest rates, which affects everything from mortgages to credit cards. If you're carrying debt, prioritize paying it down. Fourth, diversify your investments. Some sectors will benefit from this bill, others won't. Don't bet everything on one outcome. Fifth, stay informed about the political process. This bill still needs final Senate approval, and things could change. The version that becomes law might be different from what's being discussed now. Finally, think long-term. Whether you support this bill or not, the fiscal pressures it creates will shape American politics and economics for years to come. Make sure your financial planning accounts for that reality. The One Big Beautiful Bill is really a perfect example of how politics and economics intersect in ways that directly affect your wallet. It's also a fascinating case study in how even allies can disagree when ideology meets fiscal reality. Elon Musk's opposition to Trump's tax plan shows that there are genuine philosophical differences about how to approach government spending and debt, even among people who generally agree on other issues. For you as a consumer and investor, the key takeaway is this: short-term tax benefits are great, but they come with long-term costs. The question isn't whether you'll benefit from lower taxes now, many people will. The question is whether the overall economic approach is sustainable. We're essentially choosing between immediate gratification and long-term fiscal health. There are reasonable arguments on both sides, but there's no avoiding the fundamental trade-off. What's your take? Do you think the immediate tax benefits justify the long-term debt? Or do you side with Musk that this is fiscally irresponsible? Let me know in the comments. If this breakdown helped you understand a complex policy issue, please hit that like button and subscribe. We take these complicated political and economic stories and break them down so you can make informed decisions about your money. Remember, understanding policy isn't just about politics. It's about understanding how government decisions affect your personal finances. The more you understand these connections, the better decisions you can make. Thanks for watching, and I'll see you next time on Finance Simplified.